A mixed bag from Barclays. The British lender posted a quarterly loss of £764 million, swinging from profit in the same period last year. A legacy DOJ settlement relating to mortgage mis-selling between 2005 and 2007 hit the bottom line. However, stripping out charges, Barclays saw net profits more than double, topping the street's forecasts. Joining me now to discuss UK bank earnings is Eric Moore, fund manager at Miton Group. Eric, thanks so much for coming in. So clearly the jury's really out when it comes to this stock. There's a real mix on the street between bulls and bears, and the share price has really been oscillating in terms of its reaction to the earnings. What did you make of the numbers and where do you stand?
You're absolutely right, the real two-way pull. I mean, the company is asking us to look through the bad stuff, look through the fine, look through the increasing PPI provisions and focus on sort of the underlying numbers, which look okay, and there is an improvement. The difficulty is we've sort of been asked to do that for 8 long years now, and where there's been various sort of disappointments, extra costs, exceptional charges, penalties and fines. And the problem is that you can't totally ignore these bad numbers. They are real, they are a real cost. And the difficult bit is they do eat into the net asset value of the bank. So when people have tried in the past to make a valuation argument for buying Barclays, so you used to be able to say, well, the tangible net asset value of this bank is £2.80p a share, and the shares are £2.10. That's too big a discount. Now the trouble is that discount is narrowing, not for the good reasons of the shares going up, but because the tangible asset value has fallen. So it was £2.80 at Christmas, it's now £2.50 today, because all those fines and penalties are losses, and those losses reduce the asset value. So it remains a bit of a two-way pull.
I know you're an income investor, and we saw that Barclays decided to keep that 6.5 pence dividend for 2018. Is that attractive to you from a yield perspective?
It's okay, but not that exciting. I mean, in terms of a yield, it's respectable, but there are bigger yields elsewhere in the sector, like principally Lloyds or indeed HSBC. I think what's interesting about Barclays at the moment is that there's an activist investor has appeared on the register, Sherborne. So they've taken, it was 5.2%, is now up to 5.4%. They announced yesterday. 5.4% stake, which is enough to call an AGM if push comes to shove. They haven't set out what their agenda is, but it's quite clear that they've done these sorts of things before, usually in sort of UK smaller engineering companies rather than massive FTSE 100 banks. But they only invest where they think they can double their money on a 3 to 5 year view. So they're getting into Barclays at £2 because they think somehow there is a path to £4. So I don't know quite, they haven't said quite what that journey is, but I imagine it will be to focus on the more profitable bits of the bank, which would include the UK High Street Bank, Barclaycard, which is a good business, and probably do a bit less of the investment banking. Do
you think that activism could be anything to do with the management as well? Because there's been a lot of distractions when it comes to the CEO, Jez Staley, and this whistleblower fine. Do you think he's got his eye on the ball?
I think that makes it easier for an activist to get the engagement and the intention of shareholders, because the board isn't that well supported at the moment, and there are sort of question marks about the leadership that we're getting from the chief executive, and also the fact that the board has kind of stuck with him even though he's been called out as being not exercising due diligence, skill and care, and he's going to be handed a big fine by the FCA. And
there's also this big broad shift as well. We've seen it in a number of banks, whether it's Deutsche Bank, Credit Suisse, moving away from investment activities and more towards wealth management and other businesses. And Jez Staley is very much an investment banking guy.
That's right. And when he turned up at the bank, actually they cut the dividend to invest more in the investment bank, and I think many people sitting in chairs like mine think that's kind of the wrong way around. Rather, there was more dividends and less investment bank, and I think that's the agenda that the activists are going to pursue. Now, the investment bank is a big thing, and not all of it I think is bad, but somewhere in there are some businesses that are not making a very good return on the capital that they consume, and if we can do less of them, that's probably a good thing for Barclays. Now, the tricky bit is that's easy to say sitting here in the square mile. It looks easy on paper, but as we saw for companies like Credit Suisse, when you start doing it, then the revenue attrition is pretty brutal, so you lose revenue, and actually you don't necessarily liberate a lot of capital.
Although it's been paying off for Credit Suisse now.
Eventually.
Yeah,
but
it needs a bit of time to work through. Yeah. So if we could just switch focus to Lloyds for a second, because on first glance the numbers look good. Pre-tax profit, £1.6 billion, 23% rise. But the shares weren't reactive positively. It's not the only stock that suffered from this, but what were investors not liking? Or was it just the fact that they'd already been heavily bought ahead of the earnings?
Yeah, Lloyds seems a bit stuck as a share price. I mean, and it's probably one I've been getting wrong, because I thought it should be moving along now. And I think people are looking for a bit more excitement, and Lloyds has sort of been painted as a bit boring. So I suppose the negative are that that the loan book isn't growing. But I kind of think that's not necessarily a bad thing, as long as your current business is profitable and they generate a lot of profit, and then now they're in a position where they can start handing that over in dividends and share buybacks.
And net interest margins was a key area of strength for Lloyds.
Absolutely.
I mean, if you look at Santander, for example, as a comparison, that really struggled in the UK market, and Lloyds kind of put it to shame there a bit.
Yeah, absolutely. Well, I mean, Lloyds has got a very strong market position. They have sort of market shares, to die for, really, in lots of areas of consumer banking. So mortgages, current accounts, savings accounts, small business lending, and now credit cards since their recent acquisition. They've got sort of 20 to 30% market shares in the UK, right? So this should be a license to print money. And actually it's becoming that. So they're taking the costs out. I mean, regrettably, they're going to close more branches, and and there'll be more use of technology. But that's going to reduce the cost base further, improve the efficiency. It makes it a bit boring. They can't really grow because their market share is already so high. And so they do well just to keep what they've got, and so maybe that doesn't give it the sort of spice that maybe some people are looking for. But actually, boring banking should be good. But it's going to be it's kind of a new experience that actually a bank can become just a sort of dividend machine. Can they actually get there? And there's been I suppose it's taken a bit longer because they've had to increase the capital they held on the balance sheet again. So people thought 13% core tier 1 was enough, and now it seems it needs to be 14, so that's more money that doesn't go in dividends, it goes onto the balance sheet. And then again, PPI has raised its head again, as is actually going to soak up a bit of cash. But exactly. In Lloyd's case, it wasn't too bad. I mean,
so we saw Lloyd's raise its provisions for PPI to £90 million, by £90 million. Do you think ultimately next year that will finally draw a line under the issue when the deadline comes to an end? I know you mentioned that it also impacted Barclays as well.
So I think it was more of a surprise for Barclays that the increase at the Barclays provision was 400 million increase in the provision, when Barclays was only 90, and Lloyds has a bigger market share in consumer banking, so it suggests that Lloyds had been more prudent about it. But that there is, because of the FCA campaign with the Arnie head, does seem to be stimulating yet more claims. And the banks have to go through all these claims. It's the cost of processing as well as the cost of redress. Now the good news is that this is probably a last surge before this is finally timed out in August 2019, which is still some time away. What is, I guess, a particularly bad sign is usually, well, in the previous years when the PPI provisions have been increased, it doesn't usually happen until the end of the year. So it's quite a worrying sign that the banks have had to take an extra provision in Q1. So we're only so early in the year and they're already having to increase the provisions. It's quite a bad sign.
So we've been seeing a real focus on digitalisation as a key theme. The CEO implementing this 3-year plan just early in the year, pledging to invest £3 billion. Do you think that's the right way to spur growth, investing in the mobile app, closing down branches? We know as well there's going to be a number of store closures and job cuts as well. Is this the way to grow now?
It won't grow the loan book, but it will reduce the cost base. So it should improve profitability. Yeah. So as I said, they're not going to, the categories they're in are, they're the kind of, the cards have been dealt.
That kind of adds to your boring bank argument.
Yeah, but it reduced the cost base, and they can then, in which point they can extend their competitive position even further, and then give some of that back into servicing customers in terms of better prices and maintain their market shares. But yeah, it's just going to become sort of computer says yes kind of approach. And they're sticking in relatively vanilla areas, maintain those market shares. But I think the use of technology is, it reflects, the changes we see all around us in all areas, but, they don't need all these branches. The footfall in branches are down double digit. People just don't go to branches.
I just want to ask you as well about
I get cross if someone sends me a cheque these days, because I have to,
Yeah.
So, why they don't need these branches?
No, you're right. So I just also wanted to ask you more broadly about what you're looking at in the income space. I know last time we spoke, we were talking about the fact that rising bond yields were making those boring sectors like utilities, the traditional income playing stocks, a lot more difficult, and you are having to take riskier bets. Does that mean moving into financials? What other sectors are you looking at? Any stocks in particular? Yeah,
that's a good question. So bond yields, continue to nudge up a bit, but
so much focus on this 3% handle in the 10-year, maybe a bit too much focus.
Absolutely, but it's in the UK we're still a lot lower. But you can see that the yield curve is beginning to steepen a bit, and it's reasonable to expect that the interest rates at the front end of the curve, so the rates that the central bank set, are likely to rise.
So are you predicting a hike in May then?
Well, that seems to have gone off the boil a bit. But,
the unreliable boyfriend.
Yeah, absolutely, flip-flopping. But, the next move in rates is definitely up, not down. Yeah. But the journey towards normal is going to be very long. So it's going to be quite a painful process, but I think in general you probably want companies that are going to benefit from a steepening and rising rate environment, which talks to industrials, financials,
any names
resources.
In particular?
So I think it's quite boring again, but resource companies. So Shell reported today. And people used to worry about the dividend there because they pay a 47-cent dividend every quarter. And Q1 last year, they only had 43 cents of earnings, so the dividend wasn't covered. That's not sustainable. But lo and behold, helped by a higher oil price, 70 cents of earnings today. So that 47 cents of dividend this quarter is totally justifiable. And on this basis, the shares yield 5.5%. It's the biggest company in the market. It's still going to be around. The oil price. Who knows, but it doesn't feel to me like it's going back to 40, 30 bucks anytime soon. And as long as it's above 60, then your dividends are perfectly safe. Within financials, I do own both Lloyds and Barclays and some HSBC. And some of the life insurance companies, again, are quite interesting, I think, because they're benefiting from long-term trends towards more individual savings, the shifts from defined benefit pensions to defined contribution, and shifts in longevity.
Okay, Eric, thank you so much. That was Eric Moore, Fund Manager at Miton Group, joining us to talk about the banking earnings this week. Thanks for watching IGTV. I'm Victoria Scholar, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis, and expert commentary.